What are financial funds? Generally speaking, what comes to mind when we hear financial funds is money. While this is accurate, this term perfectly describes a pool of money. Usually, pooling money is a way to achieve a specific financial goal that is probably capital intensive. This is exactly what financial funds represent. They build apps for pursuing your financial goals. What are financial funds? Generally speaking, what comes to mind when we hear financial funds is money. While this is accurate, this term perfectly describes a pool of money. Usually, pooling money is a way to achieve a specific financial goal that is probably capital intensive. This is exactly what financial funds represent. They build apps for pursuing your financial goals. While the main goal of my blog and podcast is investments, there are also some other types of financial funds that are not directly investment related. One example of them is emergency funds. Emergency funds are your savings for unseen circumstances such as job loss, major illness, prolonged illness, or some other major expense. One thing one should understand is that emergencies are most likely to occur at the most inconvenient time. A general rule for emergency funds is to keep the worst of at least your 3 months' expenses. Another example is trust funds. And the trust funds are legal arrangements that entitle a person, called beneficiary, to some valuable assets of another person, called grantor. The trust company holds the assets until a certain condition is met, and then they may release them to the beneficiary. Such example is the beneficiary turning 18, which is very common, especially in Great Britain or US, where the trust funds are most popular as well. Trust funds give the beneficiaries a financial foundation to build on and can be an efficient tool to transfer wealth across the generations. Another example is retirement funds. This type of funds is kept specifically for the inactive years of an individual's life. Employees contribute money to their retirement accounts with an expectation to have stable cash flow at the later stage in their lives. And one last example in this podcast of non-investment funds is college funds. This type of fund is common in some jurisdictions and is used to finance the children's college expenses. College funds can have tax benefits attached to them, and also they can provide your children with something to fall back on in case you are not financially stable in later years when you need to provide for their education. And finally, we come to the topic of investable financial funds. There are some types of funds that relate to investments and help you grow your money. These funds include mutual funds. Those are funds from individual investors that are invested mainly into stocks and bonds. Money market funds. These are some of the most liquid types of mutual funds that generate money for investors through short-term securities, such as treasury bills or commercial paper. Also, there are exchange-traded funds, or ETFs. These are publicly traded on exchanges, and this is what makes them different from mutual funds. And finally, hedge funds. Those are pools of money from high-net-worth individuals or institutions with specific investment purpose. They use high-risk investment strategies and instruments such as derivatives. These funds can use short selling and high leverage to seek higher returns on investments. Keeping financial funds can keep you financially healthy and help you to achieve your long-term and short-term financial goals. And overall, in the long run, they could help you build your wealth.